Do you stake or lend crypto? If so, then there are tax advantages and implications that you need to know. If you make tax mistakes when it comes to staking or lending crypto, then you could find yourself in a hot water with the IRS. Welcome back to Taxes Made Simple. I'm your host. My name is Karlton Dennis, and in today's video, I'm going to teach you everything that you need to know about taxes for staking and taxes for lending crypto that can keep Uncle Sam off your back and keep you and I making those sweet crypto staking and lending rewards hassle-free. So let's dive in. All right, guys, what is staking? Before we get into taxes for crypto staking, let's first quickly discuss what staking is. Staking is a process in which people who own certain cryptocurrencies use their cryptocurrencies to generate passive income. One of the primary ways that staking is done is by participating in the so-called proof of stake consensus process for various cryptocurrencies. What this whole proof of stake is a method of validating transactions, many transactions that are happening on the blockchain. And cryptocurrencies rely on this to uphold the integrity of their networks. With the proof of stake method, people who own a particular cryptocurrency offer a certain amount of this cryptocurrency to the blockchain network as collateral. Once the crypto has been offered as collateral, aka staked, the person who staked it can become a validator for a group of transactions known as blocks. Every time a block is added to the blockchain, rewards are given to the validators, usually in the form of cryptocurrency that is being staked. So basically, staking gives you the opportunity to become a transaction validator and give you the possibility to earn rewards for validating. Staking cryptocurrency is very similar to putting money into a high yield savings account. Once you stake the crypto, you just sit back and let it earn money every day, every month, passively. However, even though putting money into a high yield savings account and staking crypto are similar, staking can have a much higher yields, which is why a lot of people are choosing to go onto the blockchain. What popular cryptocurrencies use this proof of stake for consensus? Some of the most popular cryptocurrencies that use proof of stake are these ones as follows: Cardano, Polkadot, Cosmos, Solana, VeChain, Tezos, and Theta. Ethereum is also going to be switching from proof of work, another consensus method, to proof of stake at some point in 2022 that they've announced. Now, crypto staking versus crypto trading is what I want to focus on next. If you're in this category, then don't worry. We're going to clear up some of this mess and break it down pretty easily for you. The biggest difference between crypto trading and crypto staking and investing is that with crypto trading and investing, the goal is to make money through capital gains or the appreciation of assets over time. Whether that is short periods of time or long periods of time, that's what the goal is. With crypto staking, the goal is to create passive income that flows to you periodically without you having to sell any of the underlying assets. So in other words, with crypto staking, we use our cryptocurrencies as collateral and we are paid rewards to do so. These rewards are very similar to interest and dividends. With crypto trading and investing, we are making actual purchases of cryptocurrency and holding on to them for a period of time with the hope that when we sell them, their underlying value will be way higher than the value at the time we purchase them. Now, that is the whole goal and the difference, but taxes for crypto staking falls into a different category. The first thing that you need to know about taxes for crypto staking is that the IRS has not provided clear guidelines for it yet. In fact, there are lawsuits pending currently against the IRS regarding staking taxes. Okay, for example, two Tezos stakers, Joshua and Jessica Jarrett, sued the IRS over income taxes for their Tezos staking rewards, claiming that the staking rewards should not be subject to ordinary income taxes because cryptocurrencies are viewed as property according to the IRS. So here's how the Jarretts broke down this claim. The Jarretts claim that just as a baker does not have to pay taxes for the creation of bread, but only for the sale of it, cryptocurrency stakers should not have to pay for income taxes for the new coins they create through staking, but only have to pay taxes after they sell the coins. This lawsuit is yet to conclude, guys, but it is likely that the eventual ruling could have a massive impact on the way staking is taxed in the crypto network. But for now, it is generally assumed by most tax experts that staking rewards are taxed as ordinary income. This means that your crypto staking rewards are taxed at your ordinary income rates. So if you fall into the 24% tax bracket, staking your rewards will be taxed around 24% marginally. If you fall into the 32% tax bracket, then your crypto rewards are taxed at 32%, etc. The taxes are generated for the rewards based on the fair market value of the rewards on the day you receive them. So for example, if you receive $700 in crypto staking rewards on a day, then this would count as $700 in ordinary income, regardless of how the value of the crypto rewards are paid in fluctuations throughout the rest of the tax year. And what this means, taxpayer, is that every time you receive a staking reward, you need to calculate the US dollar value of the reward and keep track of it. Confusing. When it's time to pay taxes, you'll add up the values of all of the staking rewards you have received, and then you'll just add it to your income on your tax returns. There are two different ways to report the staking income on your tax returns though. So if you are doing staking as a hobby, then you can report it as other income on line 8 of Schedule 1. However, if you are earning staking rewards as a part of a business operation, then you can report your earnings on a Schedule C like a normal business does. In this case, you would be subject to self-employment tax at 15.3%. However, you can deduct any expenses that might be associated with your staking business, such as like a home office. Once the IRS provides more clarity on the tax rules for staking rewards, everything will be much more concrete. But for now, it is the safest bet to just report 100% of your staking rewards as other income on line 8 of Schedule 1 or as self-employed business income on your Schedule C. All right, guys, now that we covered crypto staking, what about crypto lending? This is where it can get a little bit confusing. The reason is because lending cryptocurrency is very similar to staking, but it is not quite the same. There are many decentralized finance or DeFi platforms is what we call them, where you can lend your crypto and get paid fees periodically for doing so. Companies such as BlockFi offer this service. These companies make money by taking the crypto that you lend to them, and then they lend it out to someone else, typically a corporation, for a higher interest rate than what they pay you. And they take some of the interest and then they pay you for some of it. So for example, let's say you want to make money by lending crypto to BlockFi. So let's say you lend $1,000 worth of Bitcoin to BlockFi. BlockFi might pay you 4% interest annually on your Bitcoin deposit, and they might lend it out to another third party for 8%. After giving you your 4%, they keep the remaining 4% interest that they generated by lending out the Bitcoin. This circumstance is similar to staking because you are still generating rewards with your existing crypto. That's the similarity. It's just that instead of providing it as a collateral to a blockchain network to use for transaction validation, you're providing it to a lending platform that pays you fees periodically for lending them the crypto. Just as with staking, the IRS will most likely create more literature in the coming months or future that provides better clarity about the rules for crypto lending. But for now, it is the safest bet to report the income you make from lending crypto either as other income on line 8, like we talked about, Schedule 1, or self-employed income if you're running a business operation on Schedule C. Here's my opinion. Right now, crypto staking and lending taxes, in addition to taxes for other decentralized finance areas like yield farming, liquidity providing, they are the hot button issues for the IRS right now. And every year, more and more people participating in these things, because crypto and blockchain in general are gaining steam, is going to cause more IRS audits. However, because all of these things are so new and in many cases so complicated, the IRS is still playing a little bit of catch up. In the coming years, there will most likely be a lot more clarity for the tax rules for things like crypto staking, crypto lending. However, right now, the best thing to do is just to play it safe. What that means is that if you are generating profits from the sale of your cryptocurrencies, then you should consider your profits capital gains that are subject to either short-term or long-term capital gains tax, depending on how long you held onto the asset. If you're making money by providing crypto as collateral, as we discussed, or by lending it, then you should consider your profits as ordinary income subject to ordinary income tax rates. Whatever you do, just make sure that you do not assume your crypto staking or lending rewards are not subject to any taxes at all, because the majority of this time they will be. That's it for this video, guys. I sincerely hope that you were able to learn something valuable from it. If you did, I would greatly appreciate it if you would like this video, comment, subscribe, let me know where you're at in your crypto journey. I look forward to providing you with more cryptocurrency information to keep you sound on your wealth building. My name is Karlton Dennis. I look forward to seeing you on the next video. Over and out.